3 Federal Reserve officials just voted to make your money more expensive. Not to hold, not to cut, to raise. The biggest open revolt inside the Fed in decades. And 48 hours later, Big Tech gave its answer. $725 billion of spending this year. Inflation be damned. One of these two is wrong about the future, and whichever one it is, you're holding the bill. Today's timeline is about which one. Here's the one force tying this week together: the price of money. That's all an interest rate is. It's what it costs to borrow the future for your mortgage, your credit card, a company's data center, the government's own debt. For 15 years, that price was basically zero, and everything you watched get weird in the economy got weird because of it. Now, money has a price again, around 3.5%. And this week, 3 markets voted on whether that price is right, on the same ballot in the same 48 hours. The Fed voted first. It held rates steady, but 3 officials formally dissented, saying money should cost more. That almost never happens in public. Big Tech voted second. The 4 biggest cloud companies told Wall Street they'll spend around $725 billion this year building AI infrastructure, most of it borrowed against the future. A bet that only works if money gets cheaper, not dearer. And crypto voted third. Bitcoin climbed back to around $65,000, while its own fear gauge dropped to 25. Extreme fear, price up, nerve down, the one market refusing to celebrate. Same question on every ballot. What should money cost? 3 different answers. Let's take them one at a time. Start at the Federal Reserve, Wednesday afternoon. The rate setting committee held the benchmark rate at 3.5% to 3.75%. On the surface, nothing happened. Read one layer down, and it's the most interesting Fed meeting in years. 3 members of the committee formally dissented, and they dissented toward a hike. They looked at the same economy you live in and said, money is still too cheap. Inflation is not finished. New Fed Chair Wersch called it a good family fight. That's one way to put it. Here's the structural read. Fed chairs spend their entire careers manufacturing the appearance of consensus because the committee's real product isn't the rate. It's certainty about the rate. When dissent goes public and clusters, it's historically been a turning point signal. It happened around the 94 tightening shock. It happened at the 2019 pivot. When the committee fractures in the open, the smart money stops reading the official statement and starts reading the dissents. And the dissenters have a case. Yes, oil cooled this week. West Texas crude eased to around $82 as tanker traffic through the Strait of Hormuz picked back up. Yes, consumer sentiment just hit a 5-month high, mostly because gas got cheaper. That's the Dove's whole argument. The inflation scare is passing. Hold the line. But households are telling the same surveys that everyday prices are still squeezing them. Sentiment is up because the pain got slightly smaller, not because it stopped. 3 Fed officials looked at that gap and voted to keep tightening. September is now a live meeting in both directions. Now watch what happened next, because the timing is the story. Within 48 hours of 3 central bankers voting to make capital more expensive, the 4 biggest technology companies on Earth stood up one after another, and committed the largest private infrastructure spend in history. The combined number for this year, around $725 billion. That's up 77% from last year's $410 billion. Amazon around $200 billion. Microsoft around $190. Alphabet $175 to $185. Meta up to $135. Goldman Sachs now models over $5 trillion of combined spending by 2030. $5 trillion on data centers, chips, and the power to run them. And here's the part nobody predicted last week. The market paid them for it. Days ago, the financial press was calling this a market in revolt over AI spending. Then the earnings landed. Microsoft rallied about 15%. Amazon jumped about 10% in the pre-market on its earnings beat and its AI chip business. Nasdaq futures up better than 1%. The revolt lasted exactly until the checks cleared, and the exception proves the rule. Apple, the one giant without a monster AI spending story, fell about 7% on soft services and China numbers. Think about what the market just told you. It is now explicitly sorting the biggest companies in the world into 2 buckets. Spending borrowed money on AI, rewarded. Not spending, punished. At the exact moment the central bank is debating whether borrowed money should cost more. Expensive money is supposed to discipline exactly this kind of spending. Big tech just tripled down anyway. Somebody's model of the future is broken, the Fed's or theirs. Which brings us to the third vote, the one market with no earnings calls, no buybacks, no spin. Crypto is the purest bet on the price of money that exists. And its vote this week was the strangest of the three. The price says relief. Bitcoin climbed about 2% to around $65,000 after the Fed held. The total crypto market recovered to about 2.3 trillion. No hike now beats a hike, that's the mechanical red. But the sentiment says something else entirely. The fear and greed index, crypto's crowd thermometer, fell to 25. That's extreme fear, down from 28 the day before and barely off last month's low of 11. Bitcoin dominance is sitting at 56%, which means even inside crypto, money is hiding in the safest asset it can find. Ether around $1,900, no rotation into risk, no alt season. Add this week's texture. Another cross-chain bridge hacked, this time OneChain's Cardano bridge, while regulators in Washington circle with new rules, and you get a market whose price recovered and whose nerve didn't. Here's why that matters beyond crypto. Stocks are trading like the hike, threat is noise. Volatility is under 17, indexes near highs, greed on. Crypto, the fastest, most liquidity-sensitive money in the system, is trading like the threat is real. The two tapes disagree. One of them is early, and students of past cycles will tell you, when price recovers while fear deepens, pay attention. That divergence is usually resolved violently, in one direction or the other. So that's the ballot. 3 Fed officials say, money's too cheap. A $700 billion corporate machine is acting like it's free. And the most honest crowd in the market is scared. That's not 3 stories, that's 1 story, wearing 3 costumes. So, what does this mean for your money? Not advice. I don't know your life, but here's the structure, so you can make your own call. First, understand what you actually own. If you hold a broad index fund, you are not diversified the way you think. The handful of companies driving this week's rally are the same companies making the $700 billion bet. Your retirement account has become, in large part, a wager that AI infrastructure pays off before expensive money forces the issue. Maybe it does. The internet build-out eventually paid, massively. But the people who funded the fiber in '99 mostly didn't live to collect. The companies that came after did. Know which side of that trade your money is on. Second, for the first time in 15 years, doing nothing pays. If rates hold near 3.5%, or the dissenters win and push them higher, cash, treasury bills, and money market funds pay you real money to wait. An entire generation learned that cash is trash. That lesson has expired. The higher for longer world punishes leverage and rewards patience. That's not doom. That's the first time savers have had the wind at their backs since 2009. Third, watch the gap between the 2 tapes. Equities are priced for the comfortable ending. Spending pays off, no hike lands. Crypto is priced for the uncomfortable one. You don't have to guess the winner. But when the calm market and the nervous market disagree this loudly, position sizing matters more than prediction. The honest move isn't picking a side, it's making sure neither outcome ruins you. And the empowering part, the part nobody's selling you something, will say, every force in this episode is watchable for free. The Fed's votes are public. The Capex numbers are in the earnings filings. The fear index updates daily. The people who get hurt at turning points are rarely the ones without information. They're the ones who outsourced their attention. 15 minutes a day. This show is one of them. And you are, quietly, ahead of most of the market. One line on the record, nothing here is financial advice. It's a map of who's deciding what they're betting and who pays if they're wrong. The decision stays yours. Now the question I actually want you to sit with, If money at 3.5% is too expensive for a family carrying a credit card, but apparently free for a $725 billion corporate build-out, who is the price of money actually set for? I want your real answer in the comments. Not a slogan, your read. This channel gets smarter when you argue with it. And as always, 2 pills on the table. Blue pill, trust the system. The Fed held, sentiments rising, oil's cooling, and the most sophisticated companies on earth are investing in the future. Ride the index, ignore the family fight. Comfortable. And most years, right? Red pill, believe the dissenters. Money keeps getting more expensive. The perfection priced into this market meets gravity. And the crowd showing fear today was early, not wrong. Harder path, better odds if the 70s rhyme. Blue or red? Tell me which and why. Tomorrow the jobs data starts landing and September stops being an abstraction. If today's episode made the week make more sense, subscribing is the one click that teaches the algorithm this channel should exist, and it's free, unlike money. We watch the forces, you keep the decision. The timeline keeps moving, we will see you in the next one.